did some other things in the meantime, like many people did, and then got back into the exchange industry at the beginning of 2016. I've been with 1031 Corp for 5 years now, and was very happy to get back into exchanges again. I do tend to do some of the more complex exchanges in our office, as well as a lot of just general 1031s. I've got a lot of years of experience in the real estate industry in general. I was an escrow officer for a period of time as well, worked for a local home builder, and have been in the Bend area for 30 years now. I can't believe it. So hopefully I can answer your questions. So today we're going to go really briefly over, just a brief overview of 1031s in general, because it really sets the stage for some of the other topics we're going to talk about. We're going to discuss a little bit more than sometimes we do about how the basis and depreciation work with a 1031 exchange. And then we'll get into some of those other issues that come up with partnerships, related parties, and then touch on reverse and improvement exchanges as well. So what is a 1031 exchange? Code section 1031 of the IRS tax code, provides that no gain or loss is recognized in the exchange of real property held for productive use in a business or investment. And so that simply means that the IRS gives you an opportunity, if you have held property as a long-term business or investment property, to exchange that for new business or investment use property and defer your capital gain. It gives you more buying power, and it generates, puts more money back into the economy rather than just taking your cash and paying the tax, encourages you to reinvest that. So with the 1031 exchange, you can use any type of business use or investment property. It's been in the tax code since 1921, so this is the 100th year of 1031 exchanges this year. A lot of people don't realize it's been around that long. And it just allows a continuity of your investment. And so, as long as you're reinvesting those funds, it allows you to continue to roll that forward until you eventually dispose of that investment property. And this is just kind of a graphic that shows the timeline. You sell a piece of property, you close on your relinquished property, that begins your time clock. You've got up to 45 days to identify potential replacement properties, and you've got a full 180 days to complete your 1031 exchange to take advantage of the benefits of the 1031 exchange. A key requirement again is that these have to be business or investment use property. You can't, sell your primary residence or purchase a primary residence. With the sale of a residence, the tax code gives you a better deal on that. You can take advantage of section 121, which says that if you've owned your primary residence for or have lived in your primary residence for 2 out of the last 5 years, you can take up to a $250,000 gain as an individual or $500,000 gain as joint filers, and that's completely tax-free. So that's a better deal than 1031 because it's tax-free, it's not deferred. And you can do that every 2 years. So this really is designed for business and investment use property. You have to use a qualified intermediary, so you may not receive the funds from your sale and put them in the bank and go out and pick out a new property on your own. That does not qualify. It has to be an independent party. It can't be someone that has provided professional services for you within the last 2 years, such as your CPA, your attorney, your real estate agent. That's where we come in. I mean, that's all we do. We act as a qualified intermediary. And the exchange has to be set up prior to the closing of the sale. Very important, especially when things are moving as quickly as they are right now. We're getting a lot of phone calls from people at the closing table or within a week of closing that are saying, gosh, we're closing right away and we just heard about this, what do we do? Very important that we get this set up prior to close of escrow, because the exchange can never have control of those proceeds. Sorry, I'm here. I think, Krista, I'm hearing you. Was there a question? No?
No, sorry.
That's okay. That's okay. Again, the time periods are critical. Beginning of the closing date on the sale, you've only got up to 45 days to identify potential replacement property. That identification does have to be in writing, provided to us and received in our office within that 45-day identification period. It is not required in the tax code that a property be under contract. Literally what it says is you can identify 3 properties unambiguously. You could identify a property that isn't even for sale. Now that would seem like a silly thing to do, but as far as the code's concerned, it's not required that you be under contract. However, I think all of us would agree in today's market, it's kind of risky to identify a property that isn't under contract, because chances are somebody else is going to buy that out from under you if you haven't written an offer. And unfortunately, once the 45-day time period is over, there are no, you can't make replacements, revocations, you can't make any changes to that identification. So after the 45th day, we can only release exchange proceeds to purchase property that was identified within that 45-day identification period.
We have a couple quick questions here. One's from Linda. She asked, have you heard if the 1031 exchange program will be going away in the near future? Paul Carter asked a similar question. I know we kind of talked about that before some people joined.
Yeah.
So I don't know if you wanted to quickly, and then another last question is, can you explain what properties can 721 exchange can be used for?
So I am not familiar with 721 exchange. I don't know what that is.
Could be a typo, I'm not sure.
But to address the question of whether 1031s are going away, the quick answer is we hope not, but we don't have a crystal ball. I was saying earlier, our professional organization, the Federation of Exchange Accommodators, we do work closely with a lobbying firm in Washington, D.C. that keeps us well apprised of things that are going on and speaks on our behalf and gets us involved at the federal level in, meeting with, when we could, as we can, meeting with lawmakers and talking to them about our industry and kind of explaining the value of the industry. It's part of the tax code. So like any other part of the tax code, it's subject to change. It could happen. In 2018, they did away with personal property exchanges. Some of you may remember, you used to be able to exchange business assets and not inventory, but things like collectibles, and you could even exchange cattle, and you could exchange airplanes that were used for business use, and that was all eliminated in 2018. So so changes can be made. We hope that that's not the case. We don't think that's going to happen this year. We think that there's enough other stuff going on that this is probably small potatoes. But for anyone who isn't already on our mailing list, please do let me know. I'd be happy to put you on our mailing list. You can we send out quarterly newsletters. Anytime there's big legislation changes, things like that, we will send out a blast. So that would be, a way that we could keep you updated on that. So I'll jump right back in, again, touching on the 45 and the 180, your exchange has to be completed by that 180th day. I have been asked a lot this year, in last year, about extensions because of COVID. Obviously, that has inhibited people's ability to travel, to view properties, even, in some cases, just to go enter properties and view them. There was an extension at the beginning of 2020 that extended some deadlines to July 15th, but after the expiration of that extension, there has not been any other COVID-related extensions offered, and we've been told there will not be. So, unfortunately, that is the case. In the case of federally declared disasters, there are extensions to these time periods that may be granted. For example, the entire state of Texas has been granted a federally declared disaster. And so If there were people who were trying to buy property in that area, or if they lived in that area and were affected by the snowstorms and the power outages, they may be subject to an extension. So that's really the only time that extensions are granted. This same taxpayer is very important. It's critical. When you do a 1031 exchange, the same taxpayer that owned the property that was sold must purchase the new property. And a lot of times you'll hear people say the same name, not necessarily the same name. As far as the IRS is considered, we are all our taxpayer identification numbers, whether that's an individual or whether it's an entity. And so what's really important to think about is who reports that property as an asset on their tax return as far as being the taxpayer. So, you know, that is to say that if I own a piece of property in my individual name without my middle initial, I can still buy a new piece of property with my middle initial. It doesn't have to be the exact same name. It just has to be the same taxpayer. We're going to get into this a little bit more next, or in just a minute, with partnership issues, because that's really what comes up a lot. So, you know, just briefly, to maximize your tax deferral, to have full tax deferral on that capital gain, you must acquire replacement property or properties that are equal or greater in value and equal or greater in equity, meaning you have to reinvest all of the cash proceeds. The value does take into account the closing costs. So, you know, if you're selling for a gross sales price of $400,000 and you have some buyer concessions and commissions and title and escrow fees, you know, maybe your net sales price after those closing costs are paid is $350,000, so that, you know, it's equal or greater in value, equal or greater in equity. If you don't hit either one of those, if you trade down in value or you take some cash out at closing, then you get taxed on that portion, and you can still exchange the rest. Anytime someone's doing a partial exchange, we always advise that they talk with their tax people and make sure that it still makes sense for them to do the exchange. You know, if your gain on a property is $60,000 and you buy down by $50,000 in value, it probably doesn't make sense to do an exchange to save taxes on $10,000. So that's really, you know, what we're talking about there. And when you do a 1031 exchange, you take that basis in the old property, the property that you're selling, and that basis moves forward and becomes the basis in the new property. If the new property is higher in value, then the basis is increased by the increase in the property value. But in that way, that's how the taxes kind of follow you, because the basis in the old property becomes the basis in the new property. You can continue your old depreciation schedule, and you know that carries over until you're out of depreciation. If there's additional value, you can start a new depreciation schedule on that new value, or you can combine them, and that's again up to the taxpayer and their tax advisor to discuss. So now we're just going to get you know, into some of that deeper stuff. Related party issues. This comes up fairly often. In general, it's not a great idea to purchase property from or sell property to a related party when you're doing a 1031 exchange. The IRS looks at those transactions much more closely. You have to disclose on your tax return. You actually have to check a box on the tax return that says it's a related party transaction, and we feel like that's kind of a red flag for audit. And really what the IRS is looking for is that within a family unit, and not just family unit, but we'll go through what related party actually means. That could be related entities. You know, if my daughter and I own two separate LLCs, those LLCs would be considered related parties. And so what they're really looking for is that people aren't manipulating the system to get out of paying taxes by dealing with related parties. There are some possible exceptions to the rule. If you have sold a piece of property and you purchased from a related party, and that related party also completes a 1031 exchange, there's a 2-year holding period, everybody has to hold their property for 2 years, then that could potentially work. If you're purchasing from a related party and that person is not doing an exchange and they are paying more in taxes than the taxpayer has deferred by doing the 1031 exchange, then that could potentially work. And then another common thing is if you're acquiring a larger interest in property that you already own. So, again, if my daughter and I each own 50% of a property together, and I go and I sell something else and I want to buy out her 50%, that's okay. That's okay too. And related parties, again, is a little different than what we normally think of. As far as family members, that would be children, spouse, parents, grandparents, lineal descendants. My niece, as far as the IRS's definition of related party, my niece isn't considered a related party. If I bought something from her, I would not have to disclose that as a related party transaction. And then this really just goes into a lot of other examples of related parties that deal more with entities, individuals that are also members of a corporation where they own more than 50% of the value of the stock, or more than a 50% interest in a partnership or an LLC, related trusts, things like that. We always defer to people's accountants on this. Again, disclaimer, I'm not an attorney, I'm not a CPA. My specialty is 1031 exchanges. But there are some of these issues that when it gets into, well, this is probably a risky transaction, I'm always going to defer to the accountant and say, you really need to sit down with your CPA and have a conversation, because the CPA is the person who's signing the tax return. And if there is an audit, they're the person that's going to be defending that taxpayer. And so I want to make sure the taxpayer and their professional advisor have had conversations about anything that I would consider to have additional risk, such as a related party transaction. Partnership issues come up a lot. Partnerships, and I am including in this also not just like a true partnership, but also an LLC, which is for all intents and purposes also a partnership. Many people hold their properties in LLCs for the legal protections. Partnerships can exchange under 1031, but the partnership is the tax-paying entity. The individual partners don't own real estate. They own shares of a partnership. And those are not, you can't exchange shares of a partnership or stocks, things like that. So the partnership has to do the exchange. And this is fine if you have two partners who want to continue to be partners. But what happens many times is we have situations where partners no longer want to own property together. A partnership is a little different than a tenancy in common. And when someone says to me, I own property with a partner, then my very next question is, are you in a partnership or an LLC, or do you own it as tenants in common? Many times they'll say, oh no, we own it as tenants in common. But common vernacular is to say, that's my partner. That's an important distinction with the 1031 exchange, however, though, because if you own a 50% interest and someone else owns a 50% interest and you own those interests as tenants in common, then you do own a 50% interest in real estate. And that does give each of the tenants in common the ability to exchange, not exchange, go their separate ways, pay the tax. They can decide what to do with that. But if they're in a true partnership or an LLC, it's not quite that easy. So again, if some of the partners want out, there are a few ways that they could potentially structure that. One of the partners could buy out the remaining partners prior to selling the property, so that the partnership itself would still do the exchange, but maybe one of the partners got bought out, they're no longer part of that. But what you can't do is you can't use the proceeds of the sale to buy out the partners. That creates some tax issues that just don't work with the 1031 exchange. So oftentimes, what people will do is what we call a drop and swap. And, meaning that the partners of the partnership or the LLC dissolve the partnership, liquidate the assets, deed the asset to the individual partners and tenants in common. The best case scenario is they close all their bank accounts, they file a final tax return, and then they hold the property as tenants in common for a period of time. The longer, the better. Up to a year would be great. There was a tax case here, Bolfer versus Commissioner, where there was a 3-month holding period, and that was disqualified. Unfortunately, most of the time when I'm having this conversation with people, they've already signed a purchase and sale agreement to sell the property. And they're closing in 30 days, 60 days, 90 days, and saying, we don't want to exchange together. Dropping it out just prior to a sale is a pretty risky thing to do. And some jurisdictions more than others, particularly California has really gone after those. If I talk to somebody in California, I would say, don't even try that. They're not gonna be happy about that. And the reason why is because, again, with a 1031 exchange, you are selling property that you have held, that the taxpayer has held as a long-term investment. The partnership has held it. If the partnership then drops it out to the tenancy in common, and the partners now own it for a month or 3 months or 4 months, that's not a long-term hold. And chances are they'll never even get the opportunity to report that asset on their individual tax returns. And so there are definitely inherent risks in doing that. The kind of reverse of that scenario would be the swap and drop, where the partnership exchanges, sells the property in the partnership name, and then maybe what they do is maybe the partnership has 2 people in it, and the partnership goes out, they each identify the property they want to end up with eventually, and the partnership purchases 2 pieces of property, holds it in the partnership name for a period of time, again, at least a year would be great, and then they liquidate the partnership and deed property A to partner A and property B to partner B. So that's another way of potentially making that work. Any questions on that before we move on?
I don't see any at the moment, but.
Okay. So another thing that comes up a lot, again, with the market as it is today, people are looking at some alternative ways to reinvest their funds without paying the tax. And I have been asked probably more in the last 6 months than in a very long time about, well, can I sell my rental house? I own a piece of property outside of town. Can I sell my rental house and build on that property? Again, it's a great seller's market, not a great buyer's market. So it's a good time to sell. People are making money, but to do an exchange, you have to go spend that money. And so people are, looking for ways, obviously, to make that make sense. Unfortunately, you cannot use exchange proceeds to build improvements on property that you already own or that you have owned within the last 180 days. So no, you cannot take exchange proceeds and go build on a property that you already own. But there are ways to sometimes make improvements to existing property, or even in some cases newly acquired property. The easiest way, again, going back to the idea that you may not use exchange proceeds to build on property you already own. So if you're looking at a piece of property, let's say, that needs a new roof, and it's going to cost $12,000 to put a new roof on it. The minute you close on escrow and you take title to that property, you now own it. And so now you can't use the remaining exchange proceeds to make those improvements. So one way to get around that is to require that the seller make improvements prior to closing, bump up the closing or bump up the sales price by $12,000 and ask the seller to replace the roof. I realize that that's not, that's just not always something that can work, that people aren't always willing to do that. But one way of doing it is to have the seller make the improvements. Another way of doing it is to rather than have the exchanger take title to the properties, to transfer title of that property from the seller to a builder or to a qualified intermediary of some sort. And they would hold the title to the property while the improvements were being made. And then once the improvements were made, then the property is transferred to the exchanger within the 180 days, as per the traditional exchange rules. Has to, only proceeds invested within the 180 days will qualify. And those improvements have to be identified on the identification form as well. So usually what we'll see with an improvement exchange is that we create a special purpose entity called an exchange accommodation title holder. And the exchange accommodation title holder enters into an agreement with the exchanger that they will manage a construction project, that we will take title and hold title for no longer than the term of the 180-day exchange period. And they will then, during the period of construction, so we'll borrow the money from them, acquire title to the property. As improvements are made, invoices and draw requests are submitted to us. We pay those out. And then once the improvements are done and the value of the property has increased, then that special purpose entity sells the property to the exchanger for the original acquisition costs plus the cost of improvements. Now, there are a lot of additional costs involved in doing an improvement exchange. Our fees are much higher, as well as there are generally additional title and escrow fees, because we then have to, we have the original acquisition of the property, but then we also have to open an escrow to sell the property back to them. So you've got additional title and escrow fees. So if the improvements that are being made are fairly minimal, again, in the case of a $12,000 roof or, some repainting on the inside of the house and carpet, the cost benefit, it doesn't make sense to do an improvement exchange in that way. Usually when we see those is when there are major improvements that are being made. The problem with that is that, again, we're tied into that 180 days. And so if you're doing any kind of major improvements that require permits and things like that, it's pretty hard to get that done within 180 days. And I have this conversation a lot. I have done many improvement exchanges where the exchanger was sure, we've got our contractor lined up. We are ready to hit the ground running. We are definitely going to get it done. And then we get down to day 160 and nothing's been done, or $20,000 of work has been done. And it just is always such a bummer for me, because I hate to see people spend money on something like that and then have it not work out. But then sometimes it does work out. It just kind of depends.
A couple quick questions in the audience. So Sheila had asked, what are the fees for a standard 1031 exchange?
So our fee structure, our standard exchange fee structure is, if the sales price of the property is $1 million or less, our base exchange fee is $995. $1 million to 2.5, it's $1,250. I think 2.5 to 5, it goes up to $1,550. The exchange fee is fairly minimal. That fee covers, just your normal exchange. I'm selling one property, I'm buying one property. If there are multiple properties sold or multiple properties purchased, there would be some additional fees. In general, we charge an additional $300 for if you sell one property, for example, and you buy two, we would charge $300 on that second purchase. And then probably anticipating the next question would be, on top of our exchange fee, with an improvement exchange or a reverse exchange, which we're going to talk about next, we charge $5,000 to do those, in addition to the exchange fee. So that kind of gives you a bit of an idea of the price difference. And again, that's just here for us. There are lenders involved. There may be additional loan fees, title and escrow fees, things like that. So
Another question is from James Goodwin. Can you exchange for bare land and build immediately? And does the build cost go to the greater or equal value issue? And do you have to complete the build in 180 days?
You could acquire bare land. So using this structure, the special purpose entity that we set up would borrow the money from the exchanger and acquire the bare land. And as construction is started on that, we would pay the contractor, we would pay the draws. Construction doesn't have to be complete, but you do have to have, only the value of the improvements that have been made to date will be counted toward the 1031. So let's say that the total project is going to be $500,000 when it's all said and done, but you only need to spend $350,000 to complete your exchange. We could close the exchange out at $350,000, and then you could continue to make the additional improvements. If it's a cash type of transaction, that works out pretty well. If there's a lender involved, that would not work out because the lender's not going to allow the transfer of title until there's a completion notice. So yes, that could potentially work. Another way of doing that is, if you're in a situation where the builder, the contractor can take down the lot and hold the lot while they're constructing on it, and then we just, then the exchanger can just acquire it directly from the builder, whether it's done or not done. Of course, costs go up, but most builders don't want to hold the land, don't want to have to finance construction, and so the build's going to cost you more if the builder does that. So you pay them or you pay us, I guess. Is that it on those?
Yeah, I think that answered those.
Okay, I'm just checking my time here. Okay, so let's go on and talk a little bit about reverse exchanges, because this is something that we're seeing more and more of right now. So when we get into a situation with reverse is when an exchanger comes to us and says, we found this property that we want to buy. It's exactly what we want to end up with and exactly where we want to end up with it, but we haven't sold our property yet. More often right now, people are so afraid of that 45-day time identification period because inventory is so low that folks are afraid, gosh, if I list my property and my property sells in the first 2 weeks and I have a 30-day closing, I've only got another 45 days to go out and find what I want. What if I can't find what I want? And so we're seeing a lot of people that have chosen not to list their property yet and are looking for their replacement property and then saying, well, I know as soon as I list, it's going to sell. So I want to go get what I want first. And so, there is a way to make that happen. And the IRS has provided what we call a safe harbor. So they've provided this revenue procedure that says, you may do this and here's how you have to structure it. If you structure it this way and complete it within 180 days, then that is a valid exchange that we will not question it. And so the way that we structure those, they can be done a couple of different ways. We set up this exchange accommodation title holder, again, the same type of vehicle that we would use with the improvement exchange. And that exchange accommodation title holder's purpose is to either acquire the property that the seller intends to sell, which would trigger a sale, triggers the 180-day time frame, or we go out and we acquire the property that the taxpayer wants to eventually end up with, and we hold it on their behalf until they have sold. So then, the effect of either of these structures is you always have to have a sale before you can have a purchase with a 1031 exchange. So the exchange accommodation title holder steps in and makes that happen, either by triggering a sale or taking down that property and holding it until the seller's ready to buy it through the exchange. In either scenario, we're still beholden to that 180-day time frame on the exchange. The exchange accommodation title holder can only hold the property for up to 180 days. During the period of the ownership by the EAT, we lease the property to the taxpayer. That allows them to sublet it. They pay the taxes, they pay the insurance. They are responsible for any loan payments. They take the rent in. It's as though they own the property, but it's just not in their name yet. Excuse me, I need to get a drink. The taxpayer, of course, though, needs to loan the funds to the EAT. We don't come up with the money to buy the property. And so, you know, we borrow the funds from the taxpayer and or their lender. This says most lenders are now very cooperative. I don't know that I would agree with that. If you're dealing with a lender that has any kind of a Freddie Mac or Fannie Mae product, they're not going to be able to do this. So, you know, you really need to find a lender, usually banks, credit unions that kind of have their own portfolio of loans. They have much more flexibility to work with us on the reverse exchange. And the reason being that, again, the EAT, our LLC, is holding title to the property, but the taxpayer is guaranteeing that loan. So we have to, you know, sign the note and the deed of trust, but the taxpayer is guaranteeing it. And so sometimes it's just kind of hard for people who haven't worked within that before to wrap their head around it and get it passed up the chain and make it happen. Really, reverse exchanges work so much more smoothly if the taxpayer has cash to close, and that cash could be just cash that they have, you know, sitting in an account, or it could be potentially they take out a HELOC on a property that they own to provide the cash. But if it's a cash purchase, it really works out better. 9 times out of 10, the way that we structure reverse exchanges is that the EAT buys the property that the taxpayer intends to purchase, the replacement property. So in general, that's the scenario I'm talking about. So they haven't received proceeds from their sale. They need to go acquire this new property. We take title to it. We hold it for up to 180 days, during which period they can now list the property they're going to sell, get it sold and closed so that we can transfer title to the replacement property to complete the exchange.
So we have a couple quick questions here. Can you exchange as an individual into a property, adding another person onto title?
You can purchase a property with another party as long as your undivided interest in that property is enough to complete your exchange. So if you have sold something for $250,000 and you want to go buy a 50-50, you know, tenants in common interest in a $500,000 piece of property, yes, you can do that. Or, you know, or change those percentages however they need to be so that your ownership interest is enough to complete your exchange. And again, going back to what we talked about with the partnerships, you need to buy that as tenants in common. You could not then buy into an LLC that already owns a property, for example.
Another question is, can a seller purchase with 1030 money in a different state or county, or does it have to be within the same state, such as Oregon?
Nope, you can purchase anywhere in the 50 states, and there are a couple of territories. I've never seen anybody actually buy property in Guam, but if you wanted to, you could. But in general, you know, it's anywhere in the United States. And with the exception of the state of Pennsylvania, you know, 1031, of course, is a federal tax code, and so it allows for the deferral of federal taxes. But every state other than Pennsylvania also recognizes that at the state level. So you're deferring your federal and your state taxes. Now, that does bring up, you know, every state has different tax laws. Oregon and California and many other states, for example, have what we call a clawback provision. And what that means is that if you sell property in the state of Oregon and you've deferred your federal capital gain, you've deferred your Oregon state capital gain, and you go and you buy property in Idaho. If you then sell that Idaho property in 2 years, let's say, and you do not do an exchange again, and you pay your tax, Oregon expects you to, at that point, come back and now pay them the tax that they allowed you to defer when you sold that property in 2021. So I hope that makes sense.
One more question has to do, I think, more with the reverse exchanges you just covered. And the question was, can they use equity from their existing property?
Yeah. So yeah, if you had, let's say the property that you're going to sell, you own it free and clear, you could, you could get debt on that property to pay cash for the new property. And then of course, when that property sells, that debt will get paid off. So that would work. As long as, you have to be careful when you're refinancing properties in anticipation of a sale. If you just went out and refinanced a property and bought a boat, and then you sold it and did a 1031 exchange the next month, the IRS would look at that and say, no, you were taking cash out to do some other thing in anticipation of the sale, and you could still be taxed on that. If that cash that you're taking out is being used for a valid business purpose or the purpose of the exchange, it should be fine.
And then Mark has a question on, does Oregon State clawback go back or go away after 2 years?
No. No, and I'm pretty well done. So if there's any other questions, I'm totally open to Q&A at this point. I think we're just almost at the 50-minute mark here. So, that clawback does not expire as far as I know. And some states are much more aggressive in pursuing that. California, for example, has a clawback provision as well. And when you sell property in California and buy in another state, you are required to file a form every year with California that says whether or not you have disposed of that property. They keep a real close eye on that.
Also, one of our managing principal brokers that's on the call today suggested that we just note to all agents on the call that although this is a lot of great information, he wanted to remind everyone that with a real estate license, you're not supposed to give out legal or tax advice. So this helps you navigate, but doesn't necessarily give you a license to go advise. And so definitely contact someone like Danielle or contact a CPA or something to help navigate some of this. So
absolutely, I completely second that. And sometimes I'm sure that brokers run into this just like I do. People don't like to hear me say I'm not an attorney or a tax advisor, because oftentimes I'll get phone calls from folks that'll say, well, I talked to my accountant and they told me to call you. It's like, well, I can't give you tax advice. I can, there's a certain amount of information I can give you. And really the purpose of, these classes and this class isn't to make anyone who's listening in an expert on any of this. The purpose is really just to give you the information to know, what may be available and what some of the parameters are, so that when you have clients that are exploring these options, you do know which direction to point them in. You don't have to be an expert on it. You just need to know, kind of have an idea of what may or may not be possible and where that resource would be to get more information. And hopefully that resource will be me. So
we have a few more questions in the queue. Can you talk of any options of trading into an REIT or DST product?
Yes, absolutely. REITs, REITs do not qualify. And it's strange because REITs and DSTs are fairly similar, but and DST, for those people who aren't familiar with that term, means Delaware Statutory Trust. And what a Delaware Statutory Trust product is in general, and again, I have to be careful how much information I give out about that. But in general, what happens is these companies, these sponsors go out and they buy, maybe it's a medical center in Atlanta, Georgia, or it's student housing in Louisville, Kentucky, or what have you. It's these big commercial properties. And then they sell off fractional interests in that property. And they're kind of traded more like a stock might be, and you do have to have special licensure to be able to be a dealer of those properties. But the idea is that it's a more passive investment for folks who just don't want to be landlords anymore. They don't want to be getting the call in the middle of the night when the toilet's overflowing, or have to be down on Sunday making repairs to the properties, things like that. You know, it's a passive investment. You put your money in, you end up with like a, 0.5785% interest in this whole project. And then you receive a check in the mail. As all goes according to plan, you receive a check in the mail every month for your portion of that. It's attractive for a lot of folks because it is that more hands-off passive investment. For some people, they don't like the idea of not having control of that. Once you're in a DST, in general, you can't just decide, if you decide next year or the year after that you want to take your money back out, it's not quite that easy. You can't sell them on the open market. I think some brokers will offer to send out notification to other people that already have ownership in the DST to see if they might be interested in getting, buying your portion. But in general, you're kind of in it until the management decides to sell the whole project. And rates of return on those vary. I mean, I think usually what I hear is, between 4 and 6%. But again, it's subject to anything else in the market. It may do better and it may not. But I have had a lot of clients who have exchanged back out of DSTs and bought into new DSTs. So they seem to have been, those particular people seem to have been happy with the product. But the DST industry actually got a private letter ruling from the IRS that said this product would qualify as like kind through a 1031 exchange. And that's what the REIT doesn't have. So.
And quite a few people have been asking, can you make your slides available after the presentation?
Of course, yes, absolutely.
And we can email that out on your behalf.
Okay.
And then another question is, can you do a simple math example of the basis going forward that you discussed earlier today?
Sure. So for anyone who doesn't really kind of understand how basis is calculated, and we'll just make it a super easy example. If I go out and buy a piece of property for $100,000 just in cash, or even if I had a loan, it doesn't change. I go acquire something for $100,000. My basis from day one is $100,000. I then maybe I build a shop on that property and I spend $150,000 on that shop. My basis is now $250,000. My original acquisition cost plus the cost of the capital improvements that I've made. So now I have a $250,000 basis in that property. Any kind of improved property that is a depreciable asset, like a rental house, a shop you're using for a business, every year the IRS allows you to write off some depreciation on your tax return. The depreciation reduces your basis. So in my example, if I have $250 into it, and let's say I've taken $50,000 in depreciation over the years. Now my basis is adjusted down to $200,000 because it's the money I've got into it, less the depreciation that I've been able to take. So my basis in this property is $200,000, and I decide to sell it. And I sell for $500,000. I'm just going to say the net is $500,000 to make it easy. If I sell for $500,000 and my basis was $200,000, I have $300,000 in gain. That's what's going to be subject to capital gains tax if I sell it and I do not do an exchange. So I look at that and I say, I don't want to pay, taxes on $300,000. I'm going to do a 1031 exchange. And again, simple math, I sell for $500,000 and I go out and I buy a new property. I owned a shop. I go out and buy a rental house. I want to get some income coming in. So I buy a rental house for $500,000. My basis from the old property becomes my basis in the new property. So even though I just bought that property for $500,000, I only have a $200,000 basis because it's carried over from my investment before. So if I sold that new property the next day for $500,000, even though I'm selling it for exactly what I bought it for, my basis is only $200,000. So that's where the gain catches up with you. It's not a tax-free exchange, it's a tax-deferred exchange. It follows you. And you can, and there's no limit to how many times you can keep exchanging forward. And you know, and if I bought something for $600,000, that additional $100,000 would go into my basis. So my basis would be the original 2 plus the new 100. Does that make sense? I hope.
Also, Melody Llewellyn wanted to just say great information. Appreciate you taking time to present because they know you're slam busy. So
thanks, Melody.
Dan Evans has the question, if one takes debt on existing investment property with the intention of doing an exchange, would the funds need to go to the EAT in order to exchange to qualify, for the exchange to qualify?
Well, in essence, it does. I think, Dan, what you're asking is if you were doing a reverse exchange and you took out a loan on the intended relinquished property in order to provide the cash to the replacement property, then really those funds are coming to the EAT because you're loaning them to the EAT so the EAT can go buy that new property.
And then what happens if a 1031 property is left to an heir for the deferred taxes?
Yes, that's a great question. The tax code provides that when you inherit real estate, there is a step up in basis, and the basis in that property becomes, it's stepped up to the fair market value at the time of death. So in my example there, if I, had that new $500,000 property with my $200,000 basis, and I passed away, my kids would inherit that property and the basis would be stepped up to the fair market value, the $500,000. So if they sold it immediately, the capital gains effectively have gone away. If they don't sell it immediately, they hold on to it, their basis is 500,000. So then whatever they eventually sell it, they may have some gain there, but the gain that I deferred would go away. And that's really the only time your gain goes away. Sometimes you'll hear people in the industry say, swap till you drop. Just keep kicking the can down the road until you kick the can.
And David, who asked one of the original questions about 721 exchanges, kind of sent me some more information to kind of help elaborate as to what that question was. 721 exchange allows a taxpayer to exchange rental or investment real estate, ultimately for shares in real estate investment trusts, the REITs.
It's like an UPREIT. Yeah, I am not an authority on that. I have heard of a structure where you do a 1031 exchange out of real estate, you buy into a qualifying, like a DST type vehicle, and then that DST vehicle exchanges for an interest in a REIT. So they call it an UPREIT.
Right.
And that's the 721. The 721 is the exchange from the DST vehicle to the REIT. So that can be done, but there's no going backward from that. There's no way to filter it back down so that you can end up with real estate again, as far as I know. Okay.
Is there any other questions? I don't have any others in the queue. Oh, here comes one. Since I've held a rental property for 17 years and have taken depreciation, would my CPA be the one to tell me my basis for the exchange?
I would encourage that. I mean, technically, if you look at your tax returns, your Schedule E every year, any of your investment property, it should be broken out on there what your basis for the previous year was, how much depreciation you're taking that year, and therefore kind of what the adjusted basis is. But sometimes those can get really complicated by different types of assets that might be related to that property. And so I would say that the best thing to do is, to get in touch with your accountant and just say, hey, I'm thinking about selling I think this is what I'd be selling for. Can you let me know what my basis is and what my gain would be, and what that would translate to for taxes? Because, that's all really good information to have before you make those decisions.
And another question just came up, and this is, what is Santa Finney doing these days? I mean, last time I saw a picture, she was on a bike in France, but you might know
Yeah, the
better.
last picture I saw, which I think was just yesterday, they were taking a hike in France. So yeah, they are living full-time in France and appear to be loving it. It looks absolutely gorgeous, and they seem to be very happy.
I don't see any other questions in the queue. We're right at the hour, so it's 10 o'clock. And so I want to thank you, Danielle, for your time today. And I know it is busy. If you're as busy as our escrow teams are, we know you're slammed. So we appreciate you taking time, especially at the end of the month, to actually do this class. And with that, we'll share the slides after we close this. We'll send out an email to all the participants with the slides. And then we will also have your CE certificates to you by Tuesday, probably of next week. So if you have any questions about that, feel free to follow up with us next week on that. And then we'll also post this broadcast. We'll post it, a recording of it, to our website probably later this afternoon or no later than by tomorrow. So with that, again, thank you, Danielle. Very much appreciated. People are sending their thanks and gratitude. Yep. Paul says thanks. Robert Curzon, thanks. Gary, thanks. BJ Allen, excellent presentation. So a lot of kudos. So thank you very much for doing that.
Thanks everybody for being here. Appreciate it.
Awesome. All right. We'll call that a good. Thank you very much. Everyone have a great rest of your week. And
right.
okay, take care. Bye.
Bye.